All right, in this video, we're going to talk about accounts receivable. As I mentioned in the prior video, about 98, 99% of business is business to business in this country. Suppliers, distributors, wholesalers, retailers, manufacturing, all that. It's only that final sale to the consumer that is not business to business. And so we generally give people 30 days to pay. So when I make my journal entry, when I sell something to somebody, I will have accounts receivable. And then I'll put the name of the company, Smith Co. This is the company that's going to pay me, and they owe me $1,000. And I'm going to have a sales revenue or a service revenue, some type of revenue, because the performance obligation has been fulfilled, and it's for $1,000. All right, so that's great. Now, it turns out that not all the time, but fairly often, we will give a discount if they pay early. They have 30 days to pay in full, but one of the things we didn't want to do is to accelerate our cash flow. And so we will give them a discount if they pay early. And 1% is not uncommon, 2% is not uncommon. Those are the two normal amounts. So let's say that we give Smithco a 1% discount for paying within 10 days. And so when they pay me off, that journal entry is going to be cash for $990, 1% less than the full amount, which is $10. And then I'm going to have a sales discount for $10. That adds up to the $1,000. And then I'll have the accounts receivable Smithco for $1,000. So they have satisfied their debt to me by paying me $990 within 10 days. And that's a sales discount. So you'll notice the sales discount is a debit, the sales revenue is a credit. So you could think of the sales discount as almost an anti-revenue, a negative revenue, a contra revenue. One of those terms might be appropriate. Now, what happens if Smithco waits until 30 days to pay me? Well, no problem. We're happy the check came in 30 days. We're going to say cash, $1,000. They lost the discount because they went beyond 10 days. And accounts receivable, Smithco, $1,000. All right. This method that I'm doing here is called the gross method because I'm booking the revenue for the gross amount, the $1,000. Let's say the other way, there's only two ways to do this. The other is the net method. And let's say that I'm going to do my journal entry on the net method. I will say accounts receivable Smithco for $990 and sales revenue $990. Now I do the net method when I expect them to take advantage of the sales discount and save themselves $10. When they do that, it'll be cash. When they pay me off within 10 days, it'll be cash for $990. And then accounts receivable Smithco for $990. So there's a debit, there's a credit, they offset, same dollar amount, they offset. Great. Well, what happens if, the bookkeeper gets sick and nobody pays bills for a few days and they wait till 30 days to pay me? Again, nobody's upset, right? Because they're paying me within the allotted time. So now I'm going to get cash of $1,000 and I'm going to book a sales discount lost for $10. And then I'm going to book the accounts receivable Smithco for $990. So once again, these cancel out, but this now, because it's the sales discount was a debit, the sales discount lost is a credit. So this is an extra revenue. So it adds to my revenues. It will show up on my revenues on the income statement. So that is the gross method and the net method of booking receivables. So that's the first thing we had to talk about. The second thing we have to talk about is, as we've said, not everybody who I extend credit to is going to pay me. We don't live in a perfect world. And obviously, if I knew who wasn't going to pay me, I wouldn't extend credit to them. So we're going to do what's called the allowance method, right? So, yeah, I'm going to do this I'm going to add up my days sales, and let's say I booked $100,000 in sales, and so I have accounts receivable of 100,000, and I have sales revenue of 100,000. All right. So now I know that not everybody, that this is probably 40, 50 people in here. I know that not everybody who owes me this part of this $100,000 is going to pay me. So there are three ways that we generally make this allowance for the amount of people, the number of people, the amount that they won't pay me. And all of them use what's called the allowance method. Now, an interesting thing about the allowance method is it is this estimation for bad debts. It is required for GAAP, generally accepted accounting principles. It is not allowed for tax purposes unless you are like a bank or a financial institution that is under regulatory accounting methods. But if you're just a general business out there, anything from mom and pop's convenience store to Walmart, you have to have this allowance for bad debts. You take that into account. So there's several ways I can do it. We can do it as the percent. That's a lousy percent sign. The percent of sales method. And with the percent of sales method, I just say that 3% of the sales I make are not going to be collected. 2% of the sales I make are not going to be collected. And that's all there is to it. The second way that I can do it is the percent of outstanding accounts at the end of the year. So this becomes an adjusting entry at the end of the year. All of these end up being adjusting entries, but that tends to be an adjusting entry at the end of the accounting cycle. And the other way is the aging of accounts receivable. All right, so with the percent of sales method, I sold $1,000. I am going to say bad debt expense. $3% would be $3,000. And I'm I'm going to credit allowance for bad debts, doubtful accounts, number of names you can use, $3,000. Remember, expenses are always debits. And remember, this is accrual. We book it when they are incurred. We believe that they are incurred at the time of sale. We loan them money, and we know somebody's not going to pay us. We're not sure who, but somebody won't pay us. So we have bad debt expense and allowance for bad debts. Could be allowance, bad debt expense and allowance for doubtful accounts. That's common also. All right. So now Joe Blow is not going to pay me. I find out they've declared bankruptcy. I'm reasonably sure I'm not getting any money out of this. And Joe Blow owed me $500. And so now I will write off the accounts receivable, Joe Blow, for $500. And so now their account is written off. And instead of, I'm sorry, I did that backwards. It's going to be allowance for bad debts, 500, and accounts receivable, Joe Blow, $500. Remember, accounts receivable is an asset. So we can do that. We can sell our accounts receivable. We usually don't get full dollar value on them. We might get 80 cents, 70 cents on the dollar if we sell them. Right? Depends whether we sell them with recourse, without recourse. With recourse means if the person I sell them to can't collect them, I get them back. I have to buy them back. Without recourse means that they accept the full. They're going to pay me a sum. That's going to be a lot less because if they can't collect them, they do that. But so now you'll notice the expense didn't go up, right? The expense stayed the same at $3,000, but the allowance for bad debts is now at $2,500. It started at 3,000, but I just wrote off 500, so now that balance is 2,500. There, right? Okay. That's how I do that. The other one that you'll see is the aging of accounts receivable. Let's say from 1 to 30 days is current, right? And so I'll collect 98% of those. From 31 to 60 days, I'll collect 75% of those. From 60 to 90 days, I'm only going to collect about 50% of those, and 90 plus, let's say I collect 20%. And so now I will age my accounts receivable. So let's say I have 100,000 here. This one I might only have 10,000. This one I'm only going to have, let's say, about 3,000. And here I might only have 1,000 here that's over 90 days. And so I'm going to have 2,000, right? 1 minus the 98%. I'm going to have 2,000 in bad debt. 25% of that would be 2,500, 1,500, and 80% of that would be 800. Right, and I add that all up. and I get 5,450. My accounts receivable, so now I will say bad debt expense would be 5,450, and allowance for bad debt $5,450. And so that's how I do that. Now, when I report that, on my balance sheet, I'm going to have my accounts receivable here. Remember, they're an asset, so let's say 200,000 here, and then I'll have my allowance for bad debt, 5,450. When I report that, I will report that net. So on my balance sheet, I will show accounts receivable at 194,550. Right? This minus that. And that's how I report those net. Let's see. So anyway, that's how we basically treat accounts receivable.